Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Monday, the 16th of October, Bull versus Bear webinar. Steve Miley here on the call for trade day. Welcome, everyone. Welcome. Going to go for a usual regular run through in here, but with a slight twist for the Monday, as we do on the Monday, looking at what I like to call the shape of the week, how the market is stacking up going into this week. Okay. So, and I think that's useful. I say this every time when I do this on Monday, even though we're day trading at trade day. I think it's important to look ahead to the week because it gives you an idea of if you've got a lot of data in the back end of the week or a lot of events, then it might change the volatility aspect at the beginning of the week. So that's why we go through that. So for you guys in the US who are saying good morning, Clinton, good morning, Jim, good morning, Stefano. If any of you guys want to type in and say good morning, it's nice to know we have people out there. So say hi if you want in the chat. The chat is just below. It's just below, right? Just below the. Is that right? You guys have just said hello. The chat's just below the. I think you can pop it out as well, out of the from where you're watching streaming. In the trading room. So yeah, we're going to go through the shape of the week. It gives you an idea of where the volatility points are. So we'll look at not only the what's going on today, but what we've got coming up for this week. I just want to point out as well. So where you are right now, watching this video streaming, if you're new to the webinars, just below there we have where all the reports are loaded up. Right. So every day there's two technical analysis reports. One of them we've only just started adding more recently. So they are my market chartist reports. You know, I have a separate kind of little boutique research company. My background is as a technical analyst for decades now. And so I sell those reports. Those reports you get to see are being used by institutional clients around the world. So they are being used by investment banks, being used by hedge funds, being used by institutional brokers for all of their clients as well, and real money trading accounts. So those are amongst my clients, and so you're getting access to those on both the US Treasury markets, on the 2s, 5s, 10s, and 30-year futures markets on the Treasuries. Plus we have what you guys are mostly trading, the S&P and NASDAQ E-minis, and then also on the oil chart, the crude oil future, and also on the gold future. So you got those all to look at. And then we also publish this on a Monday. So what you see on the screen right now, the weekly recap and update, that's on the right-hand pane. So on the left-hand side, we have underneath where you're looking is the technical analysis reports. I can't go to that page, and I will show you on the page. If I go to the page, I'm going to get me streaming, and we're going to get a feedback loop. So I can't go to where the page you guys are on right now, because we'll get that feedback loop. So we published this as well. This is the shortened version. This is like our bulleted point version of what happened last week, and what we've got coming up this week. I'll run through that now. Now, if you want, there's a much longer version in here. Trade Day Macro Matters, and the Macro Matters in here is a more in-depth look at what happened and what we have coming up. So take a look at that if you want some more detail. That's all in there. And so I'm not going to run through that. What I'll do today is I'll just run through the shortened version and take a look at the technical analysis reports very briefly. So this is like front and center still in here, geopolitical tensions. So you see in here, volatility reigns with heightened geopolitical tensions. The Israel-Hamas war sparked a flight to quality last week. So we saw bonds initially go higher in price, lower in yields. And then we also saw last week in here, and also a big spike in gold, okay, as a safe haven. Oil initially gapped higher, then dipped back lower, and then surged back higher on Friday. We'll talk about the gold move and the oil move shortly. Last week also we had various Fed speakers. Now they pivoted slightly to more dovish, in contrast to where we actually moved in yield. So obviously we had the flight to quality. So global yields moved back significantly lower, okay, last week, because we go higher in price because of people rushing in to buy bonds as a safe haven, right? Because of the Israel-Hamas war, okay? So because of that, bonds go up in price, and higher bond prices equals lower bond yields. Bond yields reflecting longer term interest rates, okay? So higher bond prices as the bonds are bought as a safe haven. But more recently, what we've been seeing is bonds have actually been going to higher yields, okay, not lower yields as we saw last week. We've been moving significantly to higher yields. And if I go and look, I bet I've closed the yield chart down. I think I did close my yield. Oh, no, here it is. Here's the yield chart. Okay, so this is just a 10-year yield in here. So generally, though, yields have been going higher and higher and higher and higher and higher, as you can see in here. Now, last week we saw lower yields, but that did reverse back the other way, actually, towards the end of the week. And again this morning, moving back to higher yields. But you can see in here all the way from back here. So this is back from, where are we in here? This is from May, right? Is that right? Yeah, from May. And then we had this real acceleration August through September to higher yields, okay, into the beginning of October. So this higher yield move, getting nearly up to towards 5% here on the 10-year note, okay. So this higher yield move is important because if we go back to what the Fed are saying, the Fed speakers yesterday pivoting slightly more dovish, and they nodded to these higher yields, the higher yield move acceleration that we saw through September into early October, even though we reversed that a little bit last week in here. You know, the term that's being used is that it's doing the Fed's dirty work for them. So rather than the Fed maybe having to hike rates again before the end of the year, which is what they told us at their last meeting, we'll come to the Fed minutes in here. So the Fed minutes basically said, that we had last week, basically just said higher for longer. That's been the Fed's mantra for some time now. Higher for longer, higher for longer. Okay, that's what we're getting from the Fed. But and the minutes kind of reflected that, but also a little bit of indecision in the minutes as well. Okay. And then what we saw though is the Fed speakers though last week were saying that maybe this move that we've had higher in yield, and although we saw a little bit of a reversal of that last week because of the war, okay, so we also saw this reversal back lower because of the war, but by the end of the week and then this morning, yields are popping back higher again in here. So this higher yield move in here that we've seen is making some Fed members think, well, maybe we don't need to hike rates anymore because the longer end yields are going up anyway. And longer end yields, obviously, they play into, say, like mortgage rates. Okay. So mortgage rates are going to be nudging higher anyway. And because those mortgage rates are nudging higher anyway, then does the Fed need to hike again? They maybe think about not hiking. And then just jumping around a little bit, and if we go to the CME Fed tool, look, this is the chance of this has been nudging higher and higher and higher. And then last week we got up above 90% now. This is and for those of you who are maybe new to the webinar or newish to the webinar, I'll share this link in here, the CME Fed tool. You can just Google for CME Fed tool, but there it is in there. And the CME Fed tool in here tells us, so you up in here is the meetings, okay? You see these different tabs. So for the November the 1st meeting, which is the next meeting in just over in 2 weeks' time, basically, we have a 90% chance of Fed rates being at 525 to 550. And if you look up in here, current target rates 525, 550. That's where we are right now. So there's less than a 10% chance that they're going to hike rates according to what the market believes. Okay, remember this FedWatch tool is based off of the futures. You can go and look at the methodology up here. Look up here, you can link to that and see how you use it. So these are quite good, these little methodology and user guides. But basically, you know what this is telling us is the market doesn't believe the Fed's going to hike at the next meeting. Okay? And this is from the futures market. This is taking data from let's say it's implied by Fed's 30-day Fed funds futures pricing data. Okay, so the market doesn't believe it. Okay, it's the short end futures market. And even if we look out to December now, the Fed basically said at their last meeting that they're going to hike. Right, that's what the dot plot chart told us. The dot plot chart told us more members than not wanted to hike rates by the end of the year. So one more rate hike by the end of the year. But the market doesn't believe it. And it only is going to take, remember, it was kind of a bit split as well in there, right? So it's only going to take 2 or 3 Fed members to change their mind over the next, it's 2.5 months, or no, actually, to the December meeting. It's about 2 months away. So it's only going to take a few of those Fed members to shift their views, depending on the data. And then maybe they won't hike, okay? And the vote will go the other way, and they'll stay on pause. And you can see here that's what the market believes. The market is 67% chance that they stay on pause, and that has been increasing, and that's increased because of this as we spoke about in here. There's more about it if you want to go and look in here. Look, Fed speakers. So last week we have Jefferson in here, who's a bit more of a dove anyway. And remember to go to that Hawk Dove sheet. Remember that is in here. You might want to bookmark this one as well. So we've written this article. This is out on the Trade Day main site in here. So this Hawk Dove sheet in here, okay, shows you the hawks and the doves are, okay. If we go back to the article, yes, we had Jackson, right? So sorry, not Jackson, Jefferson, excuse me. Jefferson in here. Oops, what am I doing here? Sorry, guys. So Jefferson in here, you can see is more sitting up more at the dovish end, okay, slightly more at the dovish end. So it's no surprise that, if we go and look at the week ahead in here, I should go dive in here. Jefferson speaking. Okay, Jefferson was more dovish here. Expressed his awareness of the potential impact of rising long-term bond yields on the necessity for future interest rate increases. Jefferson further recognised the need for policymakers to strike a delicate balance between the risk of insufficient tightening and over-restrictive. So a dove saying something that's fairly dovish. He's more on the dovish side, and he was fairly dovish. But one of the more hawks in the Fed here, Laurie Logan, suggested there might be less urgency in raising rates, attributing this to the higher yields. Nevertheless, she maintained a stance that interest rates should remain elevated. So Logan basically saying, yeah, higher for longer, but maybe not needing to go any higher from here. And remember, if we go back and look in here on Logan in here, Laurie Logan. Oh, this needs updating because Logan is down here more, definitely down here. Okay, I'm going to go back and redo this because I get this data from ITC Markets. So I'm going to refresh this for you guys. Okay, we'll do a refresh on that in the next 24, 40 hours. But Logan is more one of the hawks in here, and Logan certainly in here indicating a more hawkish stance. A less hawkish, more dovish stance. Let's carry on. What else we had? So, and then right at the end of the week in here, well, not right at the end of the week, on Thursday, we had the US CPI data, which was warmer than expected. It wasn't particularly hot. And again, if you want to go into more detail, you go to the macro matters in here, and you'll see in here Fed. So there's the higher for longer mantra, and there's the US CPI warmer than expected. And you can see all the data in here and how it stacked up in here. So and what the Fed are watching for on that. But it was only slightly warmer than expected in here. But the concern there is that it's quite sticky. That's the term that's being used at the moment. Although it's not going back up again, inflation rates are not coming down, okay? And obviously we want them lower, right? So inflation rates need to be heading closer to 2% before the Fed maybe start thinking about even thinking about cutting rates, okay? They're going to have to be closer, probably below 3% before they start even thinking about easing rates and making monetary policy easier. So what happened last week? Well, US stocks were higher, but then they dipped back lower a little bit. Look like they're in a basing pattern. So again, if I go in here and look at the reports in here, you can see this recovery in here. We spoke about this 43.71 level on the ES, and previously we got this double or triple bottom on the NASDAQ through 15,060.75. But the market did dip back lower towards the end of last week, questioning this basing recovery. And look at the NASDAQ in here coming right back down from below that down trend line there on the NASDAQ. So we'll certainly be watching that. The S&P didn't really get up towards its equivalent trend line. But we'll be watching still the markets re-energize to the upside in here. So even though there were some negative pressures from the end of last week, we're still holding on to a more bullish tone in here. The US dollar, you guys are not really looking at that, but a setback from multi-month low, but did rebound at the end of the week. We've spoken about yields already. The big move was oil. You can go and look at the charts in here and take a look at the charts on oil here, but it was a surging, massive rally. And then that was a, where is it in here? Plus 5 sigma rally, largest one-day move since COVID for oil on the top side. So a really big move in oil, a multi-year aggressive move for oil. And then oil futures, obviously at the beginning of last week after the war had broken out, they gapped higher, they dipped back lower to close the gap, but then surged back higher again on Friday, which caused us, we actually switched from bullish to bearish on oil in here. If I go back to the index report in here that you can download. So we did in here, so we said, look, issuing a mea culpa in here on short. So we did flip to more bearish in here. But, where is it? Sorry, it's jumped in here. Oil had this gap higher, then it went back down lower, filled the gap in here, gapped higher because of the war, went back lower and filled the gap through the middle of last week, but then the end of last week surged back higher above the high that we posted at the beginning of last week. So oil still pointing to the top side in here. Incidentally, we're going to roll this across to the November contract in here. Oil should be in there really back now onto the November contract. So we'll be rolling that forward for you going forward in here in the next day or two. What else do I have for you? So just going back in here to the weekly recap, going into this this week. So central bank side, it's a fairly quiet week for central bank, right? So we do get the RBA meeting minutes. No, I think we've already had those. So we had the RBA meeting minutes. No, sorry, they come out. I put on Monday. They come out on Tuesday. That's actually incorrect. They come out on Tuesday, and then we get the People's Bank of China. That might be interesting. We might see a move there from the PBOC on Friday. The more interesting thing is this is the last week. Now I'm going to go to the blackout. If you haven't got this is one worth bookmarking. The blackout period for the Fed. So in here we see going into this week, the Fed blackout a week and a half before the meeting. So the meetings are always on Tuesday, Wednesday, and they give the announcement on the Wednesday, right? So the next meeting is here. You can see November the 1st and the 2nd. Okay. So the meeting is on the 31st of October, Halloween, through to Wednesday the 1st, and then the announcement comes on Wednesday the 1st. The blackout period is a whole week and a half before. So there's the week before, and then there's the half week before, going back to the 29th, and then here you see, let's just make this a bit bigger. But you can see in here, it's the whole of next week. Okay, so this is the final week. This is the week we're on now. Okay, 15th through the 20th. Sorry, the 16th through the 20th of October. That's the week we're on. Friday's the last day for Fed speakers. After that, we get no further Fed speakers. So we're really going to be clinging on to Fed speakers this week to give us an idea of what we might be seeing in November. Now, the market's very much pricing in unchanged, but it'd be really interesting when we're going to get no Fed speakers for over a week and a half. Okay, so it'd be really interesting to see in the next week if any of those Fed speakers that, like particularly what we saw last week with this slight dovish shift from the Fed speakers. Remember the war that we're seeing, Israel-Hamas as well, it's going to create a break on global growth. It creates indecision. Okay, it's likely to push oil prices higher. Now that could feed into inflation, which may then make the Fed think, okay, we might need to be a bit more aggressive. But also, it's going to be a break on growth, right? It's going to slow the global economy down, okay, because uncertainty leads to a slowdown, across the world in GDP and growth rates. So it's likely to see a slowdown in growth. And if you see that slowdown in growth start to come through, and then the Fed are going to be very aware of this, they might start to shift a little bit more dovish. Not only are yields a lot higher, okay, so we've already spoken about that, but there might be this indecision, this uncertainty because of the war that could lead to further repercussions globally, could see the Fed back off and be less aggressive on their interest rates. So we might see that coming through this week. Okay, what else do I have? So that's on the central bank side. So we're watching out for the Fed speakers all of this week. Macro data for the US is relatively light, but the standout's going to be US retail sales. That comes tomorrow on Tuesday. There it is there. And we do have some other important data from around the globe. Some of this could impact us, particularly the CPI data we have from Canada tomorrow, and then the UK and the EU coming through on Wednesday. Also, Chinese important growth data and retail sales data in here on Wednesday, and that PBOC decision. Now, the other thing to keep in mind is earnings season really gets going. We kicked off earnings season on Friday, and we saw some positive results back on Friday from the financials, some of the large financials who started the earnings season. It's relatively quiet today. We have Charles Schwab is the standout there. But beyond that, we got them Bank of America and Goldman Sachs tomorrow, Johnson & Johnson also tomorrow. Then a couple of really the biggies in here in the tech area, Tesla, Netflix and ASML all reporting on Wednesday. Also Procter & Gamble and Morgan Stanley. And then into the end of the week, Philip Morris, AT&T and American Express. And you can get all of that in here. This is the calendar I use. We cannot embed this. We've tried to do this. There isn't a widget for us to embed it. Like we've got the calendar that you see here that we have embedded. This is from investing.com as well. Loads of people use this investing.com as well. Even Bloomberg have investing.com calendar in there on their site. But so you can see in here going into today, we've got very little on the macro front, very little coming through in here. We do get Harker speaking later today, twice actually. Got Harker scheduled in here twice today. So watching out what Harker has got to say in here. Oh, the RBA meeting minutes, so it's kind of Monday. It's Monday US time, but it's actually on Tuesday in Australia. But then this is the investing calendar in here. So if you look in for this week, the thing I do in here, go to the filters. Okay, guys, tick the US because we're interested in the US. We want to know the big companies as well. So we tick the 3 stars, okay? And that gives you only the big companies. If you don't tick that, you're going to get loads and loads of smaller companies as well. So it goes for this week. You see Schwab today. And then this is then ordered by market capitalization. What does market capitalization mean? It means how big the company is. Yeah? Number of shares multiplied by the share price is the market capitalization, what the company is worth in today's by today's market measures of price. Okay, and you can see in here tomorrow Johnson & Johnson, Bank of America, and then also Lockheed Martin actually, but Goldman Sachs. So these are the biggies. And then just on the right in here, note this as well. This is a little sun or a little moon. A little sun before the market opens, pre-bell, a little moon after the market closes. Okay, so there you see Johnson & Johnson, Bank of America, Goldman. These are the ones I picked out. Tesla, Procter & Gamble, ASML and Netflix coming through. Also Morgan Stanley on Wednesday. Philip Morris, AT&T Thursday. American Express, Schlumberger on Friday. So really the big ones to be watching for are the financials Tuesday, Wednesday, and then on Wednesday, Tesla, ASML and Netflix on the tech side as the tech side gets going. Okay. I'm going to run out of time to talk about the charts in here, but I'm going to run through the macro stuff for you guys. Tends to be that way on a Monday. So 5 things you need to start your day. It's initially the headlines. Basically talk about Biden going to Israel in here. So we'll see how that pans out in here. U.S. Secretary of State Blinken has been there and came back today, and met Arab leaders as well to discuss the war. Okay, so. China curbs. So this is just US putting curbs on China, not really affecting us. Goldman's, we don't really care about this in here. European stocks and equity futures kind of muted moves this morning, and little on the data side coming up today. So stocks in here, stock futures wavering, kind of not really moving much overnight, and bronze as we saw going higher in yields, lower in price, higher in yields. And Brent crude holding its position in here at the moment. Futures slightly up ahead of earnings and data. So earnings, though, earnings and data, not much coming through today. Remember, it's weighted more back into the second half of the week with those US retail sales numbers, and then also the earnings reports coming through. Really, the ones we're watching are Tuesday, Wednesday. Middle East tension keeps markets on edge. We know that. China tightens rules on short selling and bid to boost stocks. So that's happened in here. So trying to boost stocks by tightening rules on being able to go short on those. And oil holding, we've already mentioned that. We've gone through there. We've gone a quick nod to the charts in here. So for me, as I said in here, the underlying theme in here is still for the stocks in here. We did dip back lower on Friday on the ES below this 38.2% retracement. We looked at that at the end of last week. We just dipped below that and rebounded. So still pointing up for me here. That's the 30-minute ES. And then here we are on the NASDAQ. Where are we? I thought I put on the retracement on this one as well. Obviously not. Maybe put it on the daily. No. But also you can see in here, look, the market went down to this 13-period EMA and then kind of rebounded there on the daily, and on the ES flirting with that 13-period EMA as well. That's been important in the past. So here we are. I thought I did the analysis on here. Maybe it was this one in here. Here we go. So holding bang on the 50%. And that 50% comes in 15 around the 065 kind of area. But check out the charts for that, guys, in the reports I've got on that. Just quick nod to the overnights in here. So even though we had those short selling measures put in place, the Hang Seng was still down about 1%, with the Nikkei down 2% this morning. So Asia looking wobbly in here. Europe's actually been okay in here this morning, pretty much unchanged on the DAX and the CAC. That's the German and the French indices. The FTSE actually up nearly, the UK index up nearly 0.5%, and the futures in here overnight, Dow's up nearly 0.4, S&P about 0.2, and the NASDAQ kind of pretty much unchanged going into today. All right, guys, any questions? I'm going to park. Didn't go into any real detail in here on the charts in here, but you've got all the reports. Go take a look at the reports. The levels are in there that I think are important. Still, for me, carrying a positive tone into today's trading session, and very little to watch apart from Harker speaking as we go into today. No questions? Okay, all good. All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care, stay safe. I'll be back with you with another Bull versus Bear webinar tomorrow. Bye.